Hi, everybody. Welcome back to our podcast, The Ins and Outs in Selling a Business. Today, I'd like to discuss a four-letter word. Right? It's a word that, don't worry, it's not an R-rated word, but it is a word that we hear all too often that could have a major impact on business owners. It can cause anxiety, stress, influence how they run their companies, and sometimes they try to avoid it at all costs. This four-letter word can cause dissension among family members of a family business, fracture long-standing partnerships, and trigger disputes among shareholders. This word has literally created a new class of consultants. There have been hundreds of books written about it, thousands of articles and webinars, and yes, even our podcast, The Ins and Outs of Selling a Business, is partially based on it. So what is this word? This word is exit. It sometimes sends a shimmer down the spines of our clients, right? Planning an exit can be a daunting task. We all know that. But not planning could have a major implications on you, your family, and how buyers look and value your business. So when you're ready to exit, and the exit door is over here, when you open that door, do you want to see just darkness with no path forward? Or do you want to open that door and see sunshine? That is a path that you choose when you're ready to exit your business. We discussed this before. The old adage says, we're all going to exit our business at some time. Just a matter of fact. It is what it is, right? So proper planning with the right advisor will allow you to exit your business, on your terms and the timing that works for you. So to talk about certain aspects of exit planning, we're really pleased and happy to have with us today Richard Austin of Integrated Partners. Rich, how are you?
Good. How are you doing, Keith? Good
Great.
being here today. Thanks for the invite.
We appreciate it. Integrated Partners is an independent registered investment advisory firm. They have a national platform, over 200 advisors, and currently manage north of $16 billion in assets. And I just read that they were named to Barron's list of the top 100 registered investment advisories. Congratulations on that.
Thanks a lot. Yeah, that was a big deal. We're proud of it. Thanks.
Good. Oh, it's a lot of work. I know you guys have been around since 1996, and as I said, kudos to your team and your firm. So, Rich, exit, right? It's so much finality to the word. Business owners, some embrace it and plan for it, and unfortunately, a lot don't. So, from your perspective, how do you guys look at it? I mean, when you're ready, when your clients come in, your business owners' clients, your high net worth clients, how do you approach that subject with them?
Yeah, that's a good question, and that's the initial challenge, right? That's the roadblock initially. And I'm glad you chose the word exit, because it was interesting starting off the podcast with a four-letter word. Kind of thought I knew what you were going to choose, but I'm glad you chose that one. So when you're speaking to, and this, we've had conversations about it before, when you're speaking to a business owner and you're talking to them about exit, all they can think about is, in their minds is a couple of different things. One, they're not prepared. They don't know what that means. They're not ready to exit. And then there's the inevitable 5 years from now, right? That's the time frame, but it's really not a date. And so, really, really what the conversation needs to be is about the business itself. Kind of like, talking to a business owner about the complexities that they face every day. And you and I go about it from a different way. you from an investment banking standpoint and myself from a wealth management firm. But our firm is unique because we have, with myself being an attorney by background and having a master's in tax, I've been working with business owners on, transactions, whether it's a family transaction or, a sale to, a management buyout, or a sale to a third party. Have that experience over the last, 20, 25 years in kind of pulling this together and obviously working with you. But the problem is kind of getting the business owner to kind of focus, on their business. I like to say to a business owner, they should operate their business like it's for sale tomorrow. Right. So let's follow that up with the word exit. What does that mean? It kind of puts the word exit into defining it. We're not talking about you leaving your business tomorrow or a year from now. It's on your terms. But if you operate your business like it's for sale tomorrow, that means that it's easier to run. You're creating more transferable value, in your business. So a higher price, whether it's a multiple or increasing revenues. And then you're basically at the time that you've designated to sell your business or to transfer your business to family or key employees, your options. It's basically, if you operate that way, you have a higher expectation of meeting those goals. So I think if we follow up the word exit with that definition, I think you get into a deeper conversation and then start to talk about the goals.
Yeah, I think that's a really good point, because I was thinking about this, coming to the studio today, right? And I'm saying to myself, exit has so much finality to it, and so it makes you feel vulnerable as a business owner, right? And I said, it's not really an exit. It's like a change of ownership, right? You're going to sell. We have so many clients that either sold their business and stayed on over a 2-3 year period as an employee. We have so many clients that sold a portion of their business, right? And they kept a piece, but they were able to, let's say, mitigate risk by taking some chips off the table at the point in their lives where they didn't want to spend that extra $10 million on new equipment to expand the business at 65 years old, but they felt good about how they feel and they wanted to run it. So bringing in a potential partner that's going to help you mitigate some of that risk, then you can kind of fill out your, wealth plan that integrated, put together, so that word, as you said, getting them to listen and embrace it and to see how this all works. It's kind of that next chapter, right? That next stage. So how do you guys proceed with this? I mean, it's like, you have this, it's sometimes as you hard, right? It's hard to get somebody to sit down and realize to look long term. I mean, they're battling day to day with their customers, with their vendors, with their employees, with whatever, every day. And then all of a sudden they got to kind of take a breath and think about this. How do you guys approach that?
Yeah, that's a really good question. So many different things to kind of talk about just in that, couple of statements. But yeah, let's focus on the, kind of addressing the busy business owner, and getting them to focus on the importance of growing their business and, and putting a plan in place for an exit. I think having them realize that a business that is so dependent on them is basically a negative impact, on the business, where it could be a much higher value. And so let me give you an example. So when I'm sitting with a business owner and initial discovery conversation, talking about, and you'll ask very similar questions, I know, is, around sales, who's, if it's multiple owners, a bunch of employees, and it doesn't matter what the industry is, but who's responsible for bringing in the business, bringing in the revenue. If it's predominantly, on the business owner themselves, and some of those skills have not been transferred over to key employees, a leadership team, they haven't grown to that next level, is that business really transferable the way it is today? So if the business is so dependent on a business owner, then then it's going to either they're going to have a low probability of a successful exit and most likely a much lower value. So putting that in perspective and just jumping back for a second, when how does a business owner, where do you start? What's important to kind of look at for getting a business ready for an exit? And I really think that there's three different things, and they're obvious, right? It's the business itself, it's the business owner, and it's the market, right? And so we've had conversations about this and, different times, with a business owner about, or different industries and what's going on in the market. So the market piece, you can't really control what's going on in the market, but you can be aware from a timing standpoint, and you want to be ready when it's the right time to exit. Or there's an opportunity and or there's like some type of synergy with either, strategic or private equity. But really before you get ready to get to that point, you're kind of looking at the business owner themselves, their personal mental readiness and their financial readiness, for an exit, setting that time frame of when it might be. And the business itself, is the business dependent on the business owner, the different value drivers, for a business, just increasing transferable value. And some key ones to focus on, would be the leadership team. Is there a leadership team? Are the employees happy? What is their compensation like? If there was a transfer of the business, would those key employees stay on? There's different types of compensation plans or deferred benefits that can be used in certain situations, where it encourages, it gives an employee more of an equity feel in a company rather than just being, an employee. I guess key ones that I see, and you can, you chime in here too, but when most business owners that I'm talking to, one of the big ones that I see is either high customer satisfaction. So, no, high customer concentration. So where there's, where there's a customer who's, who's basically 30% or more of their revenue, that's a high concentration. And so kind of talking to them, and I have one client that we've kind of worked through, and they've naturally actually, expanded their business and they're less concentrated on that one client. And sometimes it's hard to do because maybe your business is just so dependent on that one client and it's just a really good business model.
Or it could be the industry. I mean, we're dealing with a company in aerospace right now, and there's only 5 major players. So you're going to have concentration one way or the other. So just to back up a little bit. So you brought up a couple of key points, and we talk about these all the time. And one of the first questions that a buyer is going to ask our clients is, who owns the customer relationship, right? And if everybody points to you as the business owner, well, it's me. So the likelihood is there's going to be a longer transition period. You're going to have to stick in to make this work, depending on the buyer pool. A lot of people, everybody likes your business until, right? There's 99 reasons not to buy and 1 to buy. So everybody has a checklist, this is good, 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 and then no. And if some buyers come to the table and they say, if you own all the relationships, you know what? We're not the right buyer for you because we need you invested, and you got to roll equity, and you got to do this. And the owner could be a point in his career or life where like, stop, it's not for me. That's not what I want, right? Understanding what they want, what their goals and objectives is one thing we talk about all the time with our clients. There could be another buyer who's strategic in nature, who has a sophisticated, deep sales, not only sales team, but also processes in place and back offices. And like, hey, look, we'll transition this in a year. We'll be fine. And we're not concerned about it. So taking that approach when you're looking at a buyer pool, you have to be proactive and look at a broader based pool, because everybody's going to like your business as soon as they see the numbers. But when they start digging deep, right, and they find out who owns this, what's about this, concentration, growth, who owns the customer relationships. A lot of buyers say, look, we like your numbers, but we're not comfortable, and they're going to walk away. So from our perspective, is like, you need to bring in multiple parties at the same time to make sure you get the right fit. That's all about. So I think that's a very, very good point. And again, same with the customer concentration. Some buyers, we just sold a company a couple of years ago where they had 78% concentration with one customer. Well, who's going to buy that business? Well, the buyer was a company in the same industry, but they had 16 plants around the country. They were full capacity. They needed to put product into their place. So immediately they'd taken that concentration from 78% down to like 50%. I don't know what it is now. It's probably less than 50%. They weren't concerned about it, right? So your points are really valued. So when you sit with the owner, right? I mean, sometimes, I know it's like, well, you're a project-based business. You'd be better if you were, more of a reoccurring revenue-based business or repeat-based, But it's like when you're at a point in your career, like how do you transition that? That's a huge lift. So it's kind of like understanding where it is, and so you don't want your client to have any surprises. So you talk these things through. So there's so many aspects to it. So, and so you're asking a lot of the same questions we are. You're asking them hopefully 5 years before they get to us. And then once how do you put that initial plan in place, and that could change, right? I mean, it's not like you have one business owner you talked about what's their goals, but it could be two business owners, brother, sister, father, daughter, and one's 60, one's 50. One wants to sell. The other one's like, hey, look, I love what I'm doing. I don't want to sell. So you don't have conflicting, positions on where you are in your life and need to spend $1 million to buy this piece of equipment. And the father or brother say, I don't want to spend that. I'm going to retire in 2 years. I'll never see the return on that. Or the other one who's 10 years younger says, we need it. Otherwise our business is going to start to, we're going to start losing margin and we're going to lose to competition. So, you have to have, you run a lot of those situations, I'm sure. How do you kind of address that aspect of it? Because multiple parties are owners.
Yeah, actually, so throughout, like when I'm dealing with a business owner, a business that has multiple business owners, and whether they're related or not, I think you have to approach it. Our first meeting is going to be with all the stakeholders, all the owners, right? And then you have to have individual meetings with each one of them, kind of like just have conversations, understand each one's separate goals, and then I'll use a diagnostic tool, like, just like a survey with like 40 different questions, with each one. And then what I'll do is I'll pull it together in a comparison report and show where their gaps are, right? And kind of bring that up in conversation with the group. And then I'll ask them to go and do some homework and have some conversations amongst themselves and then come back, and we'll talk about where those overlaps were, in different value drivers for the company, some of their goals, just what their perception, for the company and how to move to a next step, and then at that, and I'll assure them that the first step is kind of understanding and having them communicate what each one is looking for to do, and then we can figure out the right strategy on how to move forward. And that's actually worked pretty well. It's been a good exercise.
Yeah, I mean, and again, when you have differentiating, views of what you want to do, objectives long term or short term, you can find the buyer pool that could satisfy both, right?
Yeah.
So you have we got to, use private equity for example, right? Look, we love to buy your business, Jim wants to retire, work for a couple of years, transition and retire, and Jay wants to, or Jane wants to stay on, and she wants to continue to run. So she'll roll some equity. She'll be part of the team, and she or he will have an opportunity to get a quote unquote second bite of the apple. So you can meet both objectives through the proper planning process. So when you're ready to put the company up for market, you take care of, Jim over here and you take care of Jane over here. We have several clients where one partner retired, and when we sold after a short transition, the other one stayed in with an equity stake because they wanted to, right? And it was actually, it was encouraging to the buyer, create a greater value because we have a continuity of management moving forward. And then we have a situation where we're talking to somebody right now, and you may see this as well. And I'd love to get your perspective on it, because where you could help in the planning. So one stockholder retired a couple of years ago, right? But he still has 50% of the company. The other stockholder is working, and since he retired, the business has only increased like sixfold. And, trying to buy out your other shareholder when he's sitting back, and looking up and say, "Oh, this is a great investment. I don't have to do anything anymore, right? And I'm making all this. I'll make all this money." And so the one shareholder is trying to buy him out, and he's like, "I'm not gonna. I don't need to sell. You're doing a great job for me." And there's no buy and sell agreements, no nothing. I mean, when you get into these multiple family members or partnership arrangements, there is a finality. Someone's gonna exit sooner than the other person. How do you guys address that?
That's a scenario that's going to come up. That came up in the past, that comes up now, and will come up in the future. And you hit the problem right on the head. If you don't, so part of the process is also having a continuity plan, because there is a difference between business succession and exit planning, right? Succession is who takes care, who operates the company when you can't, you're disabled, you pass away. So you put together these buy-sell agreements to determine a value, to make sure that there's an agreement among among the stakeholders, the owners in the companies, to say, okay, this is how we're going to value the company. This is what's going to happen, when there's a disability, when there's death, when somebody wants to retire, they're no longer active in the business. This is what's going to take place. When that's not put into place, you're in a stalemate, because that, you have to basically entice, because in most situations, you probably have a company with the same, like, everyone's got, even though let's just say, I have an example, an S Corp or an LLC, and, a non-active, business owner who has a 50% stake in a business, they probably have 50% voting rights. So legally, there's no agreement in place to, for the operation of the company with making big decisions, without getting the agreements of that non-active member or shareholder.
Right.
So it's, there's no easy fix to it, but I think there's conversations about, about value, I had this situation probably 15 years ago, my first time, 15, 20 years ago, high-end car dealership down south. Two brothers inherit a business from their dad, and each 50-50 owners. One just enjoyed money and liked to just have fun. And the other one was left his career in finance to run this business and grew it. So similar to your scenario, this situation, right? So I guess the point, I don't think we can have an easy solution, but we can make a valid point. The valid point is, document your business continuity plan, as part of a process, and working with, a team of advisors like myself and you, and with the CPA, is kind of like, put the objectives in place, identify personal and business resources, know what the value is of your business, make your business more transferable, easier to run, put a plan in place, for an exit down the road. So going back to, operate your business like it's for sale tomorrow. Review the different types of exit options, which you talked about, Keith, and which one might fit or might not. It doesn't have to be a hard decision, but you kind of narrow it down and have a couple of paths forward to where you might want to get to, depending on what the market looks like. And then a big part of it, and what I love to do, is the personal wealth and tax planning. So with my tax background, putting strategies in place for business owners to help them help them save, taxes, because, even if you get the highest value in the market for them, and I know you will, we have to put some strategies in place where we can minimize the tax impact. So the end result is more money for their lifestyle and for their goals.
Yeah. So exit planning, continuity planning, we could spend a whole season of podcasts just talking about this subject, but we're kind of running out of time right now. But I would love to have you come back to kind of talk about some case studies, some scenarios that Integrated have been involved with. in a future podcast. If that works for you, we'll have you back as a guest, and really appreciate your time today.
Thanks, Keith. Had a great time, and I look forward to it.
Richard Austin, Integrated Partners. Thank you, everybody. Again, my name's Keith D. I'm president of Osage Advisors. Osage Advisors is an investment bank working with family close sale businesses looking to sell. Typically, our clients have upwards of $5 million to $150 million of sales. To learn more about Osage Advisors, you can visit our website at osageadvisors.com. If you enjoy this podcast, please feel free to subscribe at our YouTube channel, The Ins and Outs of Selling a Business. You can email me with any questions at kdee@osageadvisors.com, or feel free to give me a call at 860-767-3273, extension 1001. Thanks again, and have a great day.